On October 29, 1929, 16 million shares changed hands on the New York Stock Exchange. The Dow lost 43 points, erasing 12 months of gains in a single day. And the most remarkable thing about all of it, the data that predicted this existed for years. It was published in newspapers, in Federal Reserve reports, in weekly government bulletins. The information was not hidden. It was ignored. People think the 1929 crash happened because of a sudden shock to the system, a bolt from the blue, an unpredictable catastrophe that blindsided a prosperous nation. That story is the mask. The real story is that the crash was an engineering problem. A structure was built out of borrowed money. The mathematics of that structure guaranteed its own collapse. The only variable was timing. The Federal Reserve published weekly reports on broker loans throughout the 1920s. These reports are still available in the St. Louis Fed's digital archive. They show broker loans climbing from $2.5 billion in 1926 to $3.4 billion in 1927 to $6 billion in 1928. By October 1st, 1929, the figure reached $8.5 billion. That number exceeded the entire amount of currency circulating in the United States. A 2022 peer-reviewed study in the Economic History Review calculated the full picture. When you combine bank lending to non-broker dealers, broker-dealer loans, and margin loans from brokers funded outside the call market, the total reached $22.1 billion by early October 1929. The New York Times reported on September 13, 1929, that broker loans had risen $120 million in a single week to a new record. The paper printed this information. Readers saw it. They kept buying stocks. This was not ignorance. This was architecture. The 1920s built a machine designed to extract maximum leverage from minimum capital. The machine worked as designed. It concentrated gains during the rise and concentrated losses during the fall. The people who understood the machine profited from it. The people who trusted it lost everything. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. Here is the modern connection that makes this story urgent. As of January 2026, FINRA margin debt hit $1,028 trillion, its eighth consecutive record high. Real margin debt has grown 505.5% since 1997. The market has grown 331.8% over the same period. Leverage is expanding faster than the assets it rests upon. This is the same structural pattern documented in the 1920s data. Andrew Ross Sorkin published his book, 1929, in October 2025. It debuted at number 2 on the New York Times bestseller list. In interviews, Sorkin identified leverage as the common thread connecting 1929, 2008, and today. The instruments change. The margin loans become mortgage-backed securities, become AI-fueled valuations. The pattern persists. Easy credit. Rising prices that justify more borrowing. Institutional reluctance to intervene. Expert reassurance that this time is different. This video will not tell you the crash was a mystery. It will show you, with the actual documents, that the mechanics were visible for years before Black Tuesday. The question is not what caused the crash. The question is why nobody stopped it. The documents answer that question. To understand the 1929 crash, you need to understand the margin system. Margin buying allowed investors to purchase stocks with borrowed money. You put down a fraction of the purchase price. Your broker lent you the rest. The stock itself served as collateral. In the 1920s, margin requirements were set by individual brokers, not by regulators. The standard requirement dropped as low as 10%. This meant you could control $1,000 worth of stock with $100 of your own money. If the stock rose 10%, your $100 became $200. You doubled your money. If the stock fell 10%, your collateral was wiped out. Your broker issued a margin call demanding more cash. If you could not pay, your broker sold your stock at the current price to recover the loan. This forced selling pushed prices lower, triggering more margin calls, triggering more forced selling. The margin system created a feedback loop. Rising prices encouraged more borrowing. More borrowing pushed prices higher. The loop continued until it reversed. Then the same mechanism that amplified gains amplified losses. The Federal Reserve understood this mechanism. The board's archival records show internal debates about speculative credit as early as 1927. A board statement from that year declared that the Federal Reserve Act does not contemplate the use of the resources of the Federal Reserve banks for the creation or extension of speculative credit. The Fed knew that margin lending was channeling credit away from productive uses and into stock speculation. The records document this awareness. The records also document the Fed's failure to act. The conflict was institutional. The Federal Reserve Board in Washington favored direct action, meaning it wanted to deny credit to member banks engaged in speculative lending. The New York Fed, led by Governor George Harrison, wanted to raise the discount rate to make borrowing more expensive across the entire economy. New York requested rate increases. Washington denied them. The two branches fought while broker loans continued climbing. When the board finally agreed to raise rates in August 1929, the discount rate reached 6%. This came too late to deflate the bubble. The rate increase tightened global credit through the gold standard and pushed foreign economies toward recession. The Fed's own historical essay on the crash acknowledges that detecting and deflating financial bubbles is difficult. This assessment is generous. The Fed detected the bubble. It documented the bubble. It debated the bubble for years. It failed to deflate the bubble because its own institutional structure prevented coordinated action. The margin interest rates during 1929 fluctuated between 7 and 20%. These rates were so attractive that industrial corporations began diverting working capital away from production to lend money to stock speculators. Companies that manufactured goods found they could earn higher returns by lending to gamblers than by making products. The incentive structure pulled capital away from the real economy and into the paper economy. The documents show this happening in real time. Investment trusts were the second engine of leverage. A handful of trusts existed in 1921. By 1926, there were 160. By 1927, there were 300. In 1929 alone, 265 new trusts appeared. The pace meant roughly one new trust every business day. Trusts issued over $3 billion in securities in 1929, representing 1/3 of all capital issued that year. An investment trust was supposed to give small investors access to professional management and diversification. The trust pooled money from many investors and bought a portfolio of stocks. The small investor owned shares in the trust rather than shares in individual companies. In theory, this spread risk and provided expertise. In practice, trusts became leverage machines. Trusts issued bonds and preferred stock to raise capital. They used that capital to buy common stock in other companies. The common stockholders of the trust captured the gains from this leveraged position, while bondholders received fixed payments. If the underlying stocks rose, common stockholders received amplified returns. If the underlying stocks fell, common stockholders were wiped out before bondholders lost anything. The structure encouraged trusts to maximize leverage. More leverage meant bigger gains during the bull market. Bigger gains attracted more investors. More investors meant higher fees for the trust managers. The incentives pointed toward maximum risk. Goldman Sachs Trading Corporation became the defining example. Goldman Sachs created the trust on December 4th, 1928. On July 26, 1929, Goldman Sachs Trading Corporation created Shenandoah Corporation. The offering was oversubscribed sevenfold. Investors were desperate to buy in. On August 20th, 1929, Shenandoah Corporation created Blue Ridge Corporation. The structure was a leverage trust within a leverage trust within a leverage trust. Each layer amplified returns on the way up and amplified losses on the way down. Goldman Sachs' own corporate history website acknowledges this structure and the damage it caused. By July 8, 1932, Blue Ridge traded at 63 cents. Shenandoah traded at 50 cents. Investors who bought at the peak lost everything. The trust structure had concentrated their losses through 3 layers of leverage. John Kenneth Galbraith documented this mania in The Great Crash, 1929. His account, published in 1954, remains in print. Galbraith showed that the trust structure was inherently unstable. The leverage that attracted investors during the boom destroyed them during the bust. The mathematics were straightforward. The consequences were predictable. The trusts sold the dream of professional management and delivered the reality of concentrated risk. The 1920s had gatekeepers. Economists studied the market. Journalists reported on it. Regulators monitored it. Bankers understood it. Every institution tasked with sounding the alarm either joined the speculation or deliberately ignored the warning signs. Roger Babson was an exception. On September 5th, 1929, Babson addressed a business conference and delivered a warning. Sooner or later, a crash is coming, and it may be terrific, he said. The New York Times published his statement. The same day, the Times published a rebuttal from Irving Fisher, the most famous economist in America. There may be a recession in stock prices, but not anything in the nature of a crash, Fisher declared. Fisher was wrong. Babson was right. The historical record preserves both predictions in the same newspaper on the same day. The market listened to Fisher. Fisher had credentials. He taught at Yale. He invented the Rolodex. He wrote textbooks that defined the field. He believed the American economy had entered a new era of permanent prosperity. High stock prices reflected genuine improvements in productivity and corporate earnings. The market was rational. The prices were justified. Fisher's analysis had a flaw. He measured the value of stocks against corporate earnings. He did not measure the leverage supporting those prices. A stock price can be rational based on fundamentals and still be unstable if the buyers are borrowing 90% of the purchase price. Fisher focused on the numerator and ignored the denominator. His analysis was sophisticated and wrong. The Harvard Economic Society published weekly letters throughout the 1920s. These letters are preserved in their entirety. After the crash, the Society continued predicting imminent recovery. Week after week, month after month, the economists at Harvard told their subscribers that the bottom was near and the rebound was coming. This continued for 2 years. In October 1931, the Society finally acknowledged that stabilization at depression levels is clearly possible. By then, the Society had lost all credibility. It closed shortly afterward. The bankers were worse than the economists. Charles Mitchell ran National City Bank. Thomas Lamont ran the House of Morgan. These men understood the margin system because they profited from it. Their banks made loans to brokers. Their banks underwrote securities offerings. Their banks earned fees on every transaction. By mid-1929, they had too much at stake to acknowledge the danger. Andrew Ross Sorkin's 2025 book details their actions. Mitchell promoted optimism in public while his bank loaded investors with risky securities. When the crash came, Mitchell sold bank stock to a family member at a loss to avoid income taxes. This maneuver saved him money while ordinary investors lost everything. The Pecora investigation later exposed these practices under oath. The gatekeepers failed because their incentives pointed toward failure. Economists built reputations on optimistic predictions. Journalists sold newspapers by celebrating the boom. Bankers earned fees by facilitating transactions. Every institution was captured by the speculation it was supposed to monitor. The structure made objectivity unprofitable. The crash destroyed wealth. The investigation that followed destroyed reputations. The Senate authorized an investigation on March 2, 1932 through Senate Resolution 84. The investigation accomplished little until Ferdinand Pecora became chief counsel in January 1933. Pecora was a former assistant district attorney from New York. He knew how to use subpoena power. He knew how to extract confessions. Pecora obtained internal records from the nation's largest financial institutions. He called executives to testify under oath. He asked specific questions based on documents they did not know he possessed. The transcripts fill hundreds of pages and are digitized through the Federal Reserve Bank of St. Louis. Charles Mitchell testified first. He admitted his 1929 income totaled $195.02. He admitted selling bank stock to a family member at a loss to avoid income taxes. He admitted National City Bank had amassed $50 million in bad Cuban sugar loans by funneling investor stock issuances through an affiliate called National City Company. The separation between the bank and the company was a legal fiction. The risk was real. The investors did not know. Edgar Brown testified about his experience as a National City customer. Brown had $225,000 in government bonds. National City brokers pressured him to convert those bonds to stocks. The brokers told him stocks were safer than bonds. They told him the market would keep rising. Brown converted his portfolio. When the market declined, Brown wanted to sell. The brokers shamed him out of selling. They told him selling was premature. They told him the market would recover. Brown's portfolio collapsed. He asked National City for a personal loan to meet his obligations. The bank denied him. At the same time, the bank continued offering non-collateral loans to its own brokers. The institution protected its employees and abandoned its customers. Brown testified to this disparity under oath. The transcript preserves his account. The final report ran 400 pages. It documented unethical tax practices. It documented insider advantages. It documented misleading securities offerings. It documented stock pools organized to manipulate prices. It documented interest-free loans to favored clients while ordinary customers paid market rates. The investigation produced legislation. The Glass-Steagall Banking Act of 1933 separated commercial banking from investment banking. The Securities Act of 1933 required disclosure of material information in securities offerings. The Securities Exchange Act of 1934 created the Securities and Exchange Commission. These laws restructured the financial system based on the evidence Pecora uncovered. The Pecora transcripts answer a question the crash itself could not. The crash revealed that the system was unstable. The investigation revealed why. The instability was not accidental. It was profitable. The people who built the system understood its risks. They positioned themselves to benefit from those risks. When the system collapsed, they protected their own wealth while their customers bore the losses. The documents do not lie. The documents show what the gatekeepers knew and when they knew it. The documents show the gap between public statements and private actions. The documents make the judgment. The reforms of the 1930s lasted decades. Glass-Steagall separated banking and speculation until 1999, when Congress repealed it. The SEC regulated securities markets with varying effectiveness for 90 years. The Federal Reserve gained tools to set margin requirements, removing that decision from individual brokers. The specific instruments of 1929 are gone. No one buys stocks on 10% margin through unregulated brokers. No one creates triple-layered investment trusts with Goldman Sachs letterhead. The financial system today looks different from the financial system of 1929. The pattern persists. Leverage remains the mechanism that amplifies both gains and losses. Credit remains the fuel that drives asset prices beyond sustainable levels. Institutions remain captured by the profits they are supposed to regulate. Experts remain incentivized to predict continuation rather than reversal. The structural dynamics that produced the 1929 crash reappear in different forms. In 2008, the instruments were mortgage-backed securities and credit default swaps rather than margin loans and investment trusts. The mechanism was the same. Leverage amplified gains during the boom. Leverage amplified losses during the bust. Institutions that understood the risks profited from them until the system collapsed. Taxpayers bore the costs. Today, the question is whether AI-driven technology valuations carry comparable structural risk. Andrew Ross Sorkin raised this question in his October 2025 book, and in subsequent interviews, he did not predict a crash. He identified a pattern. The pattern is leverage, optimism, and institutional capture. When these three elements combine, the system becomes fragile. The timing is unpredictable. The structure is not. The January 2026 margin debt figures show $1.28 trillion in borrowing against stock portfolios. This is a record high. It follows 8 consecutive months of record highs. The credit balance data shows investors now owe $878.4 billion more than they have in cash. This is also a record. The numbers are published monthly. The data is not hidden. History does not repeat in exact form. The investment trusts of 1929 are not returning. The specific abuses exposed by Pecora will not recur in identical fashion. The pattern adapts. The educational value of the 1929 crash is pattern recognition. The documents teach you what to measure. Broker loans, margin requirements, leverage ratios, the gap between credit growth and asset growth, the behavior of institutions tasked with monitoring risk, the predictions of experts who benefit from optimism. These are the pressure points. These are the indicators. The 1929 crash was not a mystery while it was happening. It was not a mystery before it happened. The data existed, the warnings existed, the analysis existed. The people who understood the structure either profited from it or were ignored by those who did. The crash did not punish stupidity. It punished trust. The investors who lost everything trusted experts who had conflicts of interest. They trusted institutions that prioritized fees over safety. They trusted a system designed to concentrate gains during the boom and distribute losses during the bust. The documents survive. They are digitized. They are searchable. They are free to access through Fraser and the Senate Archives and the National Archives. Any person with internet access can read the Federal Reserve Board minutes from 1927. Any person can read the Pecora transcripts from 1933. Any person can trace the broker loan statistics week by week through 1929. The information was not hidden then. The information is not hidden now. The question is whether you will read it. The question is whether you will measure what matters. The question is whether you will recognize the pattern when it appears in different form. The machinery of financial collapse is documented. The mechanics are known. The warning signs are measurable. The 1929 crash explained without panic is the 1929 crash explained with data. The data says this: leverage concentrates risk. Credit amplifies instability. Captured institutions fail to warn. The pattern persists until the structure breaks. The documents explain everything except the timing. The timing they cannot predict. The structure they reveal completely.